So I got a call recently from a couple who were in trouble. They were already moved into the home that they were in the process of buying, and it was a mobile home in a mobile home rental park here in California. And the situation was is that they bought the home on a lease purchase, which is where they paid an extra chunk of money to the seller for the option to buy the home, right? So they move in and they agree to a higher rental amount per month. So the idea is some of that extra rent goes towards the down payment. It's a common way of buying a home and it's pretty handy. However, the problem was is that they got pre-qualified with a regular real estate lender thinking it was the right thing to do when in fact it wasn't. The lender said 2 weeks into it, can't do this. Now, the video today is going to be about why that is. Why can't a regular lender do a mobile home loan? So I get this call about twice a month. I've been doing loans for about 20 years, and consistently about, maybe a little more or less, but about twice a month, I get a panicked call from a buyer or an agent that is in escrow, and the lender that they were going with decides, hey, can't do this loan. Big problem, right? So for the buyer, buying a mobile home feels like you're buying a house or a condo in a lot of ways. I mean, you got your bed and the roof and the walls and the space. I mean, it's like a house, right? So what's the big deal? So legally, the mobile home is classified as personal property. And that's when it's a structure sitting on somebody else's land, so the park in this case, right? But that single distinction is going to make all the difference. That's why the financing works differently. A regular real estate loan is secured by the land and the structure together. This is why this loan is secured by the home alone in terms of a personal. The mobile home is secured by the home only, and it's closer to like a car or a boat loan. And if the borrower stops paying, well, the outcome is different too, right? So in real estate, they go through a foreclosure, whereas the personal property mobile home loan is a repossession. This is why a regular real estate lender can pre-approve somebody and then discover weeks into the deal that the loan doesn't apply. It's usually not incompetence. The loan officer is probably used to manufactured on land home loans, and they assume that buying in a rental park is the same, but it's not. And many mobile home owners are told no simply because the lender they went to doesn't offer that kind of loan at all. So it's an industry-wide problem, but why is that? So the first reason is because there's a compliance overlap. So you've got personal property loans, which are like a boat or an RV or a car. Those are very easy to do compliance-wise, but if you're going to live in the property, now it's you got residential overlap compliance rules. So like fair lending, HMDA, and ECOA. A lender that usually does the boats and RVs and cars, it complicates it. It makes it a simple loan makes it much more complicated and then therefore costlier. And because of the complexity, most institutions decide it isn't worth building the business, building that expertise, right, and specializing it. And then the ones that do, they figure out, wow, this is really great. As long as we can figure it out and specialize in it, then it's a really great thing. So you've got a fork in the road. Go this way or go that way, and for most lenders. And when I say banks in this video, I mean the big banks like Bank of America, Chase, Wells Fargo. You will find some smaller banks that specialize in mobile home financing, but the big banks never will. It's just not economically feasible for them to do that. And part of the reason is because the market's small. So that's reason number two. So the market itself for mobile homes is pretty small. Manufactured housing makes up about 6% of the occupied housing in the United States, rising roughly to about 14% outside of the big cities. And within that, Homes on leased land are even a smaller slice of the pie. So you've got a small market of mobile home loans and these specialized lenders. So chattel lending nationally is concentrated in a small handful of lenders who account for more than half of the loans, right? So that's the small pool of capital. The last piece is liquidity. Any loan that's made sometimes will be sold or it has to be held on the books. Well, when the reason that a lender might produce a loan and then sell it off is they need that money back to make another loan. And that adds liquidity in the market. So that's why Fannie Mae and Freddie Mac were created back in the 70s to provide a liquidity for lenders making the loans could then sell them and get that capital back to go out and make another loan. Well, in mobile home financing, that's not available. There is no Fannie Mae or Freddie Mac. Nobody wants to buy these loans generally. So because of that, that adds another layer. You have to have a financial institution that is big enough to be able to do that, but small enough to be able to handle the complexities of a small market with a lot of compliance. So lenders that hold these that make these loans pretty much need to hold them until they're paid off, right? So it's not a gap; it's a permanent division, right? That's why actually it's happening. This couple that this happened to, right? They'd gotten the park approval residency. They called me. And we moved fast because we got them out of the real estate loan into a mobile home loan. The deal did close quickly, but not by much. It was over on time. So if they had done their homework and gone with a mobile home loan to begin with, then they would have saved themselves quite a bit of money. So who can actually do this? A mobile home lender is one that specializes in mobile home financing, understands the compliance overlap, going into this, and is set up to hold the loan rather than sell it off to an investor. A practical way to tell the difference is when you talk to your loan officer, hear what they're saying about the loan. If they're describing it in a way that they describe a regular real estate mortgage, like they use Fannie Mae term or Freddie Mac or a desktop underwriter DU approval, something like that, then they don't understand the difference. You really want to be on the lookout for red flags. So you want to ask the lender directly, do you do these loans in this park? Have you lent in this park before? And go with your gut, because a lot of lenders will say that they can when they can't. But you want to check. You ask them specifically, have you done a loan in this park before? And don't let them guess, right? You want to make sure you're talking to an expert or a specialist in mobile homes. It's a niche industry. You want to go with a niche lender. Okay, so that's what I do. I lend in mobile homes in California for the last 20 years. Also houses and condos too. I'd love to help. So if you're in escrow right now or just found out your lender can't perform, you might be early in the process. You want to get pre-qualified. Feel free. Book a call with me. You can use the link in the description. And there's also a calculator on my website that is designed for mobile home APR calculations to see what you can afford. And it's specific to mobile homes, although you can use it for regular houses and condos too.